All right, when should you withdraw from the cash side of the barbell or the stock side? So Sue writes in from the North Woods with a good question on this, and this is the third time I've had to do this video because my little doggies here yapping away. All right, good boys. All right, so let's read this. Hey Josh, Sue here from the North Woods. I know you recommend withdrawal whenever, but is there actually a better time? All we know is to buy low and sell high and nothing else. I'd like to see a visual of where to find the cost basis in low growth. Which are the funds you recommend for us to withdraw first? I'm not quite sure what she's saying there, but I think I have a gauge, so we'll go into this. We want to be good stewards of our finances and don't want to take it out if whatever the normal gauge is not favorable. All right, so we don't want to. Okay, i.e. taken out of the market when it's been down for 2 weeks or 2 months. Okay, I see what she's saying. All right, you don't need to get that specific, but we'll get into it. Also, how do you know when it's time to use your cash bucket versus withdrawing from the market? For example, if someone's going to make biannual withdrawals, how much decline is acceptable before a person taps their cash bucket? I don't want to time the market, but I do want to cash out wisely. All right. And she keeps referring to the cost basis. I'm not sure I like the cost basis connotation here, but I see where she's going. All right, so first and foremost, we get $100,000 and we need $5,000 a year. All right, so we got $100,000. We need $5,000 a year, just for simplicity, because that's a 5% distribution amount. All right, now at the end of the day, we already have $5,000 in a just a good old fashioned checking account. This right here, this $5,000 is going to cover us for the coming year, if that makes sense. I want to be clear here that the first year that you start is covered by cash. That's why I always say you got to build up your cash for at least 1 year of living expenses. That's not even included in the barbell. Hope that makes sense. The barbell is cash, I get it, but the cash component, the way the barbell works is because we want to, it's hindsight looking, and I'm going to show you what I'm talking about here in just a second, but we want to have the first year of expenditures covered by cash that is exclusive of the barbell. I hope that makes sense. All right, so in this case, we're going to put $20,000 in cash, $80,000 in stocks. All right, so we got $20,000 in cash, $80,000 in stocks. Again, we've already had the first $5K covered by just good old-fashioned checking account. If you don't have enough money in checking to cover your first year of expenditures, I highly suggest that's what you finance first. You say, I'm going to keep working until I got $5,000 or $10,000, whatever your expenditures are. I'm going to keep working until I have that literally sitting in a cash account. All right, so now what happens is a 5% distribution rate. All right, so what we're going to do is we're going to assume the market goes up 10% in the first year. All right, so plus 10. So now we're at 88,000, and we're at 20,000 in the 88,000 in the stock plate, and 20,000 in the cash plate. All right, so this right here is gone. So we need another 5K to cover us for the upcoming year. All right, so what we got to do is we're going to take it from the 88,000. So that's going to leave us minus 5K. It's going to leave us 83 and 20. All right, so 83 and 20. Because we got to take this 5K out in order to spend it. Now, Sue did ask when would be the best time to do it. Like, should she do biannually? Should she do, I don't. I just say do it for the whole year. The reason I say do it for the whole year is because it avoids some of this, I think, overthinking here. Like, should we do it when it's down for 2 weeks or down for 2 months? Or no, I'm telling you, just get it done at the beginning of the year. That way you don't have to think about it like that. It doesn't make sense to me to say every 2 weeks, because then then your market timing, you're looking too much at the portfolio. Don't. Just say, okay, the 1 January. So 1 January comes around. I ended the year at 88,000 in stocks, 20,000 in cash. I'm up 10% stocks, so let's go ahead and take some of that money and dump it and use that, if that makes sense. That's what we're going to spend on. All right, so now we're going to bring these two numbers forward. All right, so we're going to say, okay, so now we have 20K in cash and 83K in stocks. With no particular place to go, riding along my automobile. All right, so now we have this, and so it's 1st of January. We're like, well, we've already taken the money out. So now it's like this, starting at the beginning of the year. All right, we already got our money. So now the market, will say the market fell 10% here. And that is down to, what's that, about 75K. And this is at 20K. All right, so at the end of this year, we're down to 75K here and 20K here. Well, we need money for the upcoming year. Where do we get it from? Well, I'm going to take it from the cash because I hate to even use the term cost basis. Our starting value when we started this whole enterprise is $80,000 on stocks. We really want to try to avoid dropping below that with distributions, if that makes sense. So we're going to take it to 5K, which will leave us with 15K in cash. All right, so we're going to take the 5K from the cash bucket in this regard. So at the end of the day, we're left with 75 in stocks, 15 in cash. So we can bring that forward. 75 in stocks, 15 in cash. All right, so again, we got our years covered. 75 in stocks, 15 in cash. All right, so again, that's good. Now we're going to say the market fell another 10%. Chomp on chomps. Another 10%. So now we're down to 67K. All right. Well, if the market fell another 10%, we do not want to touch this over here. We want to take the money from here. So now we're going to take the money, the 5K from here. So we're sitting at 67 and 10K. So 67 and 10K. So we're going to bring that forward. And this is where it's going to get a little bit interesting because there's no right or wrong answer here. But I'll tell you what my preference is. So now we got 10K here and 67 here. All right, so now that's what we started the year with. Now we're going to say the market grew by 20%. We had a 20% increase. So now we're at 80K again. All right, so this is still at 10K. So now we're at 80K and 10K, but we still need 5,000 to cover for the upcoming year. So where do you take it from? All right, so we're right back to kind of where we started with, well, we are right back to where we started with stocks. We're down 10,000 in cash. So let's bring this forward and make it a little bit cleaner. So we're starting the year, we ended the year at 80K and 10K. We need 5,000 bucks still. Do we take it from the stocks, which are right back to where we started from? And this is the important number. In my opinion, I'd like to know, hey, I started with $80,000 in the stock side of the portfolio. Where am I at today? That should, in my opinion, that should be the starting point. Are we above that or below that? And if we're below that, we don't touch it. If we're above that, we'll get to that in just a second. But if we're below it, if we're at 80K or below, we don't touch stocks. We just don't. So in this case, I'm going to take my money from the cash account, and we're going to be down to 5,000 in cash. I hope that makes sense. So we're going to be down to 5,000 in cash because I'm taking my money from the cash account. So now what we're going to do is we're going to bring that over. We're at 80,000 in stocks and 5,000 in cash. All right. And we're just going to say we have another 10% up, or we'll even say 5% up in the stock market. We got $80,000 times 1.05. So now we're at 84. And we're at 5K. So after this year is over, we're at we had 5% increase in the stock market, 84 and 5K. Well, that's where it gets a little bit dicey. This is where it gets a little bit dicey. But I'm telling you, I'm taking 4K from here. So I want to keep it right at that $80,000 threshold. The reason for that is simple because that is the number I started with. I want to maintain right there if I can. And minus 1K here. Now, I don't think it'll ever be, obviously, I'm just pulling numbers out of the air. But so now you're at 80K in the stock portfolio and 4K in the cash portfolio. All right, but we've had, we've had a 10% upturn. We've had two 10% downturns, a 20% upturn, and a 5% upturn. All right, so we've actually done decently for sure. But we still have two consecutive 10% downturns, which are common, but that's back to back. You don't see that often. But so let's just say again now the market's up 8% for simplicity. I'm kind of looking at it almost like what happened after 2003. The market's had a couple good years, a couple moderate years. So 80,000 times 1.08. The market is up to 86.4. We'll just say 86. And I actually didn't plan it like this, but this is pretty cool. So now we're up to 86K, and we have 4K in cash. So what I'm doing here is I'm taking my 5K from the market to spend, and I'm taking 1K and I'm putting it over to cash just to get back to that number right there, 4K to 5K. All right, so basically at the end of the day, when all is said and done, we're gonna have 80,000 in stocks, 5,000 in cash, and we're 6, 7 years in. All right, so that's how we're gonna end up there. And again, if the market gives us another 10%, then we're just right back to where we were. I mean, I hope that makes sense. Now, at some point, you're going to run out of cash, and then you're just going to have to take from the market, and that's just the nature of the beast, man. At some point, you might need to tighten your belt. People say, but Josh, you're not talking about inflation. I'm not talking about inflation because, again, at the end of the day, I think inflation is dwarfed by the fact that most people spend less as they age. But you certainly can inflate that as well. That's fine. But I'm also not giving you any interest on the cash component either. So I'm pretty comfortable with that scenario for sure. There's no right or wrong answer. I just don't think this too much. People do. They say, well, what if, like Sue was saying, what if the market's down, 2 weeks time? I don't do that. I'm just telling you, so again, you start the year with X and Y. All right, so you start the year with X and Y. X is stocks, Y is bonds. Is your money, is the X up or is it down? It's literally that simple. If X is up, you take, and again, when I'm saying starting the year, but I'm also saying starting the 80,000. That is the number you want to try to sustain at all costs. I mean, you don't have to. It's completely contingent what you want to do. The issue, though, is when you don't want, if it's below 80 from your starting point, even 5 years later, you started with 80 5 years ago, now it's at 83 5 years later, and you pull 5,000 out of it, you're below 80. I would recommend you don't do that, if that makes sense. Now, at some point, you might run out of cash. All right. Well, if you run out of cash and you get a big market gain, you take money from the markets and to spend, to live on, and then you put the rest in, put the gains in cash. So let's just say we're going to go back to this for simplicity. We're going to say now we got 80,000 in stocks and nothing in cash. This is where we're standing. 80,000 in stocks, nothing in cash. And we're going to say the market gives us another 20% gain. So now we're at 96. So what I'm doing, we need $5,000 to spend. Right? So we're going to take $5,000 to spend, and then we're going to take $10,000 and dump it over here. So we're going to have 10K here. Right? So basically what we're doing, we have a 20% increase. We're going to move 10K from stocks, 5K to spend. So when all is said and done, we're going to be sitting on 10K in the cash component and 81K in stocks, if that makes sense. So no, there's no science to this. It's just intuitive. But two things jump out at me is don't make it more difficult than it needs to be. Don't overanalyze this. Think this too much and just say, okay. Again, I started $80,000 5 years ago. I'm at $96,000 now. I started $80,000 5 years ago. I'm at $72,000 now. Then you got to say, well, what do I have in my cash component? If I have money in my cash, I'm pulling whatever I need from cash because I'm below the 80,000 what I started with. If I ran out of money in the cash component and I only have 72,000 in stocks, well, I think the answer is obvious there, what you should do. If that starts to get a little bit challenging for you, like, oh, I'm running low on money, well, that's when a reverse mortgage comes in and things of that nature. Because it could happen, man. I mean, these things could happen. It could happen with a 4% rule. There's no rule that's definitive to save you from a market decline. I go back to Japan. Look what happened in Japan. No rule, 4% or otherwise, would have saved you from that. It just would not have happened. And as such, in fact, if you look at, again, the 4% rule concocted with the current rates of interest wouldn't save you even from 2001 and 2 if we came back to that again. So there's no rule that's guaranteed at all. The only way it's guaranteed is if you do an annuity. And I just don't think you should, because an annuity, in terms of income annuity, that's what I'm talking about here, not a variable annuity or anything like that. Annuity, you're locking up your proceeds. You don't have access to your own money, and instead the insurance company has all your money, but they will give you essentially your principal back over the course of 20 years. And year 21 is when you actually start making money in that. So I don't like that at all. So hope this helps, Sue. Good question. There's a lot to chomp on, but don't overanalyze this stuff. It's just try to keep it as simple as possible and just remember what you started with on that barbell for the stock side. Hope this helps. Put some comments or questions in there. Thanks now.